On October 20, 1979, the Federal Reserve held a meeting that almost nobody paid attention to. It wasn't a crisis briefing, it wasn't a political flashpoint, and it certainly didn't look like the start of anything historic. But inside that quiet conference room, the cost of money was about to be rewired, and with it, the direction of wealth in the American economy. The public saw nothing more than a technical shift in policy language, something buried deep in financial pages. Only later, when rates surged, when real yields flipped, and when the economy convulsed, did it become obvious what had been triggered. What looked like a procedural adjustment was actually the start of a new cycle that would determine who would gain and who would lose for an entire generation. The following months turned that subtle moment into a seismic shift. By early 1981, the federal funds rate neared 19%, a level the United States hadn't seen in the post-war era. For borrowers, households, small businesses, manufacturers, those numbers were a direct strike. For savers, however, sitting on high-yield deposits or short-term bonds, it was a windfall. And beneath all of it sat a deeper pattern. The cost of capital wasn't just simply responding to inflation. It was reshaping who would hold power in the coming decade. Most people didn't notice the pattern forming. But the numbers were already telling the story. Real yields illustrated the shift with brutal clarity. In 1978, the real yield on the 10-year Treasury hovered around 4.01%. Offering savers a strong positive return after inflation. But by 1979, only 1 year later, that real yield collapsed to minus 0.05%. The economy hadn't collapsed, the banking system hadn't melted down. Yet the purchasing power of savers was suddenly being drained. When real yields go negative, they do so quietly, taking value from people who don't have the tools to hedge it. That one data point was the fuse that made everything else inevitable. But the shift wasn't just mathematical, it was structural. When money becomes expensive, leverage becomes a threat. When money becomes cheap, leverage becomes a weapon. This duality is what makes interest rates such a powerful mechanism of wealth transfer. It appeared in the early 1980s, it reappeared after the 2008 crisis, and it resurfaced in the 2012 to 2019 period, when long-term real yields sat near 0.33% despite booming equity markets. Rates shape advantage long before anyone feels the consequences. The dynamic works because interest rates determine far more than the cost of borrowing. They shape who can take risk, who can accumulate assets, and who will be pushed out when the cycle turns. For the top 10%, who already held large pools of capital, the moves after 1979 were an opportunity. For the bottom 50%, who relied heavily on wages and savings accounts, the same moves quietly stripped value. These shifts didn't announce themselves. They accumulated month by month, year by year, until the gap became unmistakable. In the early 1980s, households stared down the highest mortgage rates in modern history. A 30-year mortgage could exceed 16%, meaning most middle-class families were cut off from homeownership unless they accepted crushing debt burdens. At the same time, institutional investors, which operated with large pools of capital and less sensitivity to consumer credit costs, used those conditions to position themselves for the inevitable rate cuts that followed. The moment rates fell, asset prices surged, especially real estate and equities. That divergence is the structural heart of the wealth transfer cycle. One side is squeezed, the other side waits. The same mechanism repeated decades later. After the 2008 collapse, rates were pushed to nearly 0% and stayed there for years. This reshaped the financial landscape in the opposite direction. Borrowers with access to collateral found themselves able to borrow cheaply and scale rapidly. Between 2010 and 2019, U.S. equities rose more than 300%. Meanwhile, savers, especially retirees, faced real returns that hovered near zero, with long-term real yields sitting around 0.33% by 2019. Once again, the default winners were the ones holding assets, not the ones holding cash. Behind these cycles lies a simple truth. The price of money is the most powerful redistributor in the economy. Not taxes, not wages. Not even productivity changes shift wealth as dramatically as interest rates do over long cycles. This was evident not only in the US but also abroad. In 2015, the European Central Bank pushed deposit rates to minus 0.2%. In 2016, the Bank of Japan followed with minus 0.1%. Negative rates turned saving into a losing proposition while turning borrowing, especially for institutions, into an engine of expansion. Each time, the flow of wealth followed the same direction. By the late 1970s, with inflation still high, households began noticing the erosion of purchasing power. But they did not see how the erosion was mathematically tied to the interest rate structure folding in on itself. Inflation at 13.3% in 1979 was visible. The minus 0.05% real yield was not. And yet the second number was the mechanism that determined who paid the long-term cost. When real returns go negative, wealth silently migrates from savers to borrowers, from wage earners to capital holders. As rates climbed in 1980 and 1981, something counterintuitive happened. The purchasing power of savers rebounded sharply while borrowers suffocated. This inversion is what made the early 1980s so transformative. High inflation had taken from savers. High rates now took from debtors. Each group took turns absorbing the shock. The only group that consistently benefited was the one already positioned with assets that would surge once rates finally dropped. When unemployment hit 10.8% in 1982, the pressure of high rates reached the broad economy. Factories closed, small businesses folded, and consumers delayed big purchases. Yet at the same moment, institutional investors were preparing for the next phase of the cycle, the drop. They knew capital could not stay that expensive forever. And the moment the Fed began cutting, the returns flowed aggressively back into asset markets. This was not foresight. It was pattern recognition. People often assume interest rate cycles are simply tools to manage inflation, but that belief misses the structural role these cycles play. Rates don't just react to the economy, they reshape it. They determine which business models survive, which households accumulate wealth, which markets flourish, and which communities decline. Rate cycles draw invisible lines across society, and only in hindsight do those lines become clear. By the mid-2010s, the pattern had become global. Real yields across advanced economies compressed. Negative rate territories expanded. Central banks moved from controlling inflation to actively managing economic momentum with rate tools that had never been used at such scale. And in every region where rates sat at zero or below, the same pattern emerged. Asset holders prospered while savers watched their future purchasing power erode. If the early 1980s were the peak of the expensive money era, then the 2010s were the peak of the cheap money era. Both produced opposite forms of wealth transfer, but both were governed by the same underlying mechanism. The public rarely sees these transitions for what they are. They see the symptoms: mortgage spikes, asset booms, wage stagnation, but not the core engine behind them. That engine is the price of money itself. And once that price moves, every decision households make, borrowing, saving, buying, waiting, carries consequences they cannot escape. Interest rates don't act fast, but once they begin their cycle, the outcome becomes nearly inevitable. This is why the meeting on October 20, 1979 matters so much in hindsight. It wasn't the drama of the moment. It was the doorway to an entire sequence of cause and effect. It launched the peak, triggered the overextension, and set the stage for the long unwinding that would redistribute wealth across decades. Every cycle since then, 2001, 2008, 2012 to 2019, and even the negative rate experiments follows the same structure with different surface details. The mechanism stays constant. Only the scenery changes. The signals that the cycle was entering its next phase appeared long before anyone recognized the danger. They showed up first in real yields slipping just below zero, then in corporate debt climbing faster than national income, then in the quiet drop in household savings rates. None of these signals were dramatic individually, but together they formed the same pattern that appeared before earlier turning points. In the late 1970s, real yields moved from 4.01% to minus 0.05% before the 1981 spike. In the 2010s, long-term real yields hovered near 0.33% while corporate debt exceeded $10 trillion by 2019. Patterns rarely repeat perfectly, but mechanisms do. The most subtle shift came from the way financial institutions behaved. When money becomes cheap, they expand. When money becomes more expensive, they consolidate. This is why, after years of near-zero rates following 2008, the buildup in leveraged corporate structures wasn't a distortion, it was the expected outcome. And when rates finally began rising again in the late 2010s, even by 1 or 2 percentage points, the strain hit the weakest borrowers first. It mirrored the early 1980s when businesses with thin margins collapsed under the weight of 19% interest rates, leading to 10.8% unemployment in 1982. The collapse is accelerating, but not because the economy is falling apart. It is accelerating because multiple forces that used to offset each other suddenly point in the same direction. When real yields fall, savers lose. When debt expands faster than income, borrowers become fragile. When asset prices inflate due to cheap credit, new entrants are priced out while existing holders get stronger. This is what happened between 2010 and 2019, when equities rose more than 300% while long-term real yields stayed near 0%. These are not random events. They're the logical consequence of the structure. By the time the public begins feeling the pressure, the mechanism is already deep into its cycle. Households don't notice the negative real return on savings until inflation erodes their purchasing power. They don't notice the widening gap between wages and home prices until mortgages become out of reach. They'd not notice the effect of cheap capital until asset prices double or triple beyond their earnings. The public reacts only when the symptoms appear, long after the cause has completed most of its work. As the cycle tightens, the difference between the winners and losers becomes sharper. The winners are almost always those already sitting on assets that appreciate when credit is cheap. The losers are those dependent on cash savings, fixed income, or wage growth that never keeps up with asset inflation. This was as true in the 1980s as it was in the 2010s. In both periods, capital moved upward in the hierarchy, reinforcing the position of the top 10%, while the middle 40% experienced stagnation. Data from the post-2008 period shows this jump. Clearly, wealth concentration accelerated precisely during the years of near-zero interest rates. But the mechanism doesn't simply divide people. It divides institutions as well. Large firms with access to capital markets can refinance, roll over debt, and borrow at terms that small businesses could never imagine. During the 0% rate era, big companies issued trillions in new debt, often using it to buy back shares and drive their valuations higher. Smaller companies, especially those without collateral, saw their financing conditions deteriorate even as rates appeared low. The system doesn't distribute cheap money evenly. It allocates it toward those already positioned to take it. Once a cycle reaches the breakpoint window, the pressure becomes impossible to ignore. Real yields are compressed, debt is high, and rate shifts start to bite. In the early 1980s, this window led to the violent rate peak of 19% and a recession that reshaped the economy for a decade. In 2008, it led to a freeze in credit markets and a sweeping shift to zero rates. In 2020, despite a different trigger, the collapse of global rates into emergency territory happened while debt burdens sat at historic highs. Different eras, same arithmetic. The next phase is always the unwinding. It begins quietly, credit spreads widen, borrowing slows. Asset markets wobble, and households begin to feel squeezed as the cost of living shifts out of sync with income. This happened after 1979 when inflation hit 13.3%, and again in the mid-2010s when real wages stagnated despite economic growth. People don't need to know the numbers to feel the pressure. They experience it in rent, groceries, mortgages, and savings that don't stretch as far as they used to. But even during the unwinding, the wealth transfer continues. When rates rise, borrowers suffer first. When rates fall, savers suffer later. The cycle is indifferent to who gets caught in which phase. It simply keeps moving. The only group consistently insulated is the one that holds a portfolio large enough to benefit from both phases. They profit when rates fall because assets inflate. They endure when rates rise because they can buy what others are forced to sell. That dynamic has existed since the early 1980s and reappeared almost perfectly between 2010 and 2020. Once the unwinding reaches full intensity, society begins to feel the divide. Middle-income households lose ground not through dramatic collapse, but through incremental erosion. They save but gain nothing. They work but fall behind asset appreciation. They borrow but pay more over time. The structure compresses the middle from both sides, just as it did during the late 1970s wage stagnation and again during the post-2008 recovery. Societies rarely notice this hollowing out until it becomes undeniable. At the institutional level, the realignment becomes equally stark. Capital-heavy companies use downturns to acquire weakened competitors. Financial firms reposition portfolios to capture opportunities created by volatility. Central banks intervene with rate cuts or asset purchases, which again tend to inflate markets more than wages. The cycle reinforces itself through every major actor. And each action, intentional or not, redistributes wealth according to the structure of rates. When the system reaches the stability illusion stage, it can appear calm on the surface. Markets stabilize. Rates plateau. News headlines shift away from monetary policy. But this calm is deceptive. The mechanism is not pausing, it is resetting. The early 1980s had this illusion after the rate peak passed. The early 2010s had it when zero rates felt normal. The late 2010s had it when markets rallied year after year. Stability isn't the end of the cycle, it's the inhale before the next exhale. And this is why the pattern keeps reappearing with such precision across decades. It's not because policymakers repeat the same mistakes. It's because the structural relationship between rates, yields, debt, and asset pricing remains the same. When money becomes expensive, debt breaks and savers gain. When money becomes cheap, assets rise and savers lose. When real yields drop, purchasing power erodes. When real yields rise, borrowers hit their limits. These are mechanical consequences, not policy choices. By the time the cycle completes, wealth has moved sometimes subtly, sometimes drastically from one group to another. The meeting on October 20, 1979 didn't cause that. It triggered a sequence already wired into the architecture of modern finance. The same architecture powered the post-2008 boom, the 2012 to 2019 negative yield environment, and the global rate collapse in 2020. The inputs change. The actors change. The triggers change. The mechanism does not. When you line up the data points, 1979's minus 0.05% real yield, 1981's 19% rate peak, 2008's near-zero policy rates, 2019's $10 trillion in corporate debt, the 300% equity surge, the negative yield experiments in Europe and Japan, the pattern becomes impossible to dismiss. These aren't isolated moments. They're connected steps in a process that has been unfolding for half a century. Understanding the cycle doesn't let you outrun it, but it does let you see it for what it is. A system that reallocates wealth through the most powerful instrument in modern economies, the price of money. And once that price moves, everything else follows. This isn't a prediction. It's a mechanism.